Hello, hello, and welcome back once again for a Christmas special. So today we're gonna talk about PayPal Holdings, as is the full name of the incorporation. And I'm pretty sure you're aware of the company. Pretty much everyone is. A very well known e-commerce payment company, handles payments all over the place, and I'm pretty sure most of you have already paid at least once using PayPal. It's one of the very well known vendors. And as you can see, till 2015 has been doing pretty awesome in regards to its stock price. And the company seems to be growing nicely along with the price of the stock. But as usual, we want to examine the financials of the company in order to make a better investment decision in case we are willing to potentially buy some PayPal into our portfolio. And it looks like it could be a nice opportunity over here because the stock were up to almost $300 here. Did it reach? Yeah, it actually crossed 300. And right now it's actually down to 192 yesterday. And so we want to examine and check whether it would be a potentially good opportunity for us. Now, the important thing to notice, and we're gonna be doing with this video as well, is we're gonna be using the model that I mentioned in a couple previous videos about the free cash flow and the multiple to the free cash flow. Basically, we're creating sort of like a PE version for free cash flow. This is where it is, and we're not creating it. I mean, it exists. We're just using it. And so I'm going to be using that as well as a method to evaluate whether free cash flow actually is on par with the company's stock price. So let's take a look at we did take a look at the chart. Let's start, and you can also see that it's down 30% in the 3-month period. So that's interesting to notice. There may be some potential upside later, and to 20% this year as well, and year to date 18. Okay, so let's take a look. Starting our analysis, let's first take a look at the income statement as we usually do, and let me find it here. Okay, so income wise, we have data from 2017. I don't know why we don't have 2016 here, but yeah, that's a bit no, actually I'm checking the last 5 years basically that I have over here. Yeah, okay, that's fine. We don't have 2021. We just have the current year, so the last 12 months here. So we could potentially use that, but I can also stick with the previous 4 years. So as you can see here, the total revenue of the company is growing over here, and growing year over year very nicely. And you can see that the year over year growth is about the same, 15 to 20% seems to be the average. And that's kind of a nice thing because you can project it into the future. You have like a 5-year data here, which seems to be pointing to a 20-year growth over the year. So you can use this to model your potential earnings and see whether the stock price is fair to the actual year-over-year growth that you're going to be achieving in the company for the next, let's say, 10 years. So this can actually really help you make a model that's potentially closer to what's going to happen in the future. No one knows exactly what's going to happen, but it gives you an idea. And so the net income here, as you see, it keeps growing and growing very nicely. Basically, at about the same rate, I guess, as previously seen in the total revenues. And so we're looking at a company that seems to be growing nicely year over year without any exceptions. And even in the last 12 months, still gaining some momentum here and still continuing to grow, approaching 5 billion in net income. So that's nice. Let's take a look at the balance sheet. The balance sheet over here, you can see that the total current assets of the company also seem to be growing, and obviously the liabilities will grow as well with that. That's to be expected. But let me see here. I wanted to find, okay, the total assets. Yep. So you can see the total assets here seem to be growing again nicely and without any disruptions really. So that's also nice to see. So the company seems to be, making quite some good money here. And you can see in the total equity, which is what matters, the bottom line pretty much, is also growing like year over year and nicely adding to its equity. So as a holder of this company, you will be enjoying some increasing equity year over year, it looks like. At least that's what the models point to. Cash flow. So cash flow here, we can see that, let me find the operations, the cash flow from operations, from operating activities. With the exception of 2019, which was a little bit of a slump here, you can see that the company is growing year over year in terms of its operational cash. So that's nice to see. And also enjoying some nice investing over here with some acquisitions as well. So they made an acquisition in 2020, a pretty lucrative one it looks like. Yeah, they invested also in securities, in equities basically. So that must have done some good money. Must have made some good money for them actually in 2020. That was probably good timing. And cash from financing here as well. This is in the plus here, which is generally speaking not great. But you'll see there was just a little bit of issuance of common stock here. Oh, they repurchased some stock as well, which is nice to see. We can probably take a look at the outstanding shares later to verify. And yeah, some debt over here, as you see. They seem to be getting some debt, which could be okay. I mean, these kinds of companies could be a little bit debt leveraged. That's not a huge deal, as long as they make money, of course. And the free cash flow, which is obviously the most important thing, 2 billion over here, 4.6, 3.3, as again the slump of 2019, and 5, and again like 5. This seems to be stalling a little bit. It doesn't seem to be enjoying a lot of growth over here. But what I'm going to do is I want to calculate an average of these cash flows. So I'm going to be using my trusty calculator and just go 1.8. This is 1.8. Basically, it's an easier method to calculate it just by using first two digits plus 3.3 plus 4.9. And I'm going to get this 5 as well, which is the trailing 12 months basically. So this is slightly inaccurate, but it's okay for our purpose. And just divided by 5. And we're going to get a figure of 3.92. So 3.92 is basically 3.92 billion per year is the average 5-year cash flow over 5 years basically. And we can use again a multiple that I kind of like using, which is a little bit stretched, 20. You can use a 15 multiple if you are more conservative, but I'm going to be using a 20 just because this is a growth company that's a very well-known name. And this takes me to a 78.4 billion market cap valuation based on the current free cash flow average. And right now, as you can see here, the market cap of the company is 225 billion. So it's actually almost for like 3 times, 3 times this figure. So it's probably 3 times more expensive than what you would want to get. Based on the free cash flow again. You can always evaluate companies differently, but this is a method that I really like using, just because it points me to how much money the company will be making every year, and connects that to the actual market cap of the company, which is obviously the most important thing, when you give it a fair multiple, like a multiple of 20, for example. So this is how you can derive to a pretty nice evaluation about what market cap to expect. So if the market cap is 225 billion and the expected market cap based on the free cash flow would be 78 million, let's take a look, 78 billion, sorry. Let's take a look at the outstanding shares right now of PayPal. So let me go back. PayPal over here in overview. So oops, I picked the wrong one. PayPal. All right. Okay. So the shares outstanding over here are 1.17 billion, as you see, shares. And the nice thing about it is that, as we saw earlier, the company is purchasing back shares. So this is good for investors if the company purchases back its own shares, because their shares, the ones that they currently own, are worth more because there are fewer shares available in the market. It's basically demand and supply. So whenever the company buys back its own shares, it's basically good for investors. And the opposite happens when the company is actually issuing shares, then they are diluting investors. So it's actually bringing down the price per stock, actually the amount that the investors hold per stock, just because there are more shares in the market right now, so each share is worth less. So in this case, this is a good thing that the company is purchasing back some of its own shares, at least till 2018 that was the case. And we found earlier that, what was it, 78.4 was the expected market cap for the free cash flow that we calculated. So if we divide that by the shares outstanding, the currently available shares right now on the market, so let's do 1.17, we find that the expected share price per share for this market cap that we calculated would be approaching, actually a little bit more than $67. And right now the price of the stock is 192. So it's basically similar to the market cap that we saw earlier. It's almost 3 times as much as you would expect. And so using this figure, you can get an estimate of how overvalued potentially a stock potentially is based on how much money they're making. So that's not everything about purchasing a stock, because it also depends on your risk profile. But if you are a conservative investor, that may not be doing it for you. And so yeah, it's probably a figure that you need to take a look at and decide whether it's good for you. And it's important to know that the current stock price kind of reflects a little bit of overvalued stock price compared to what the company is making in free cash flow. That's good to know. So what am I doing in my case? I love PayPal, and I think the company will continue growing. And remember, the stock market is a little bit of a voting machine, so you could easily see it go up. But at this valuation, I wouldn't buy the stock. Again, it could potentially go up because not everything is about strict numbers. But over the long run, eventually, I'm a firm believer that the company shows its true colors. Actually, and it's not even about the company; it's about the stock price. And the company is awesome, but the stock price kind of needs to be tied to the operations of the company. Otherwise, it eventually will revert to the mean in most cases. Now, hype also matters. Everything matters. The market matters as well. But I kind of like picking stocks that are maybe a little bit less sexy, but are better valuations for my wallet, I guess. So yeah, I wouldn't buy PayPal. I love the company, but I would just wait it and see. Now if it gets down to 100, maybe that would probably be a fair opportunity, even though it would still be a little bit overvalued. But then I would think about it differently, I'm pretty sure. And it also matters where it was before as well. Now, if you want to take it for a trade, I would do that, because I think this is potentially a good entry here. And I'm pretty sure it would pretty soon approach 300 again. So I wouldn't be surprised if it quickly fills this gap basically over here and goes up to its previous all-time high. It wouldn't be weird at all. All right, thank you for watching. And if you enjoyed this video, you may want to take a look at this one, where I'm kind of offering some suggestions on what are 10 of the nicest stocks to buy for 2022. And again, thank you for watching, and I'll see you in the next one. Bye bye.